We've got Pankaj Tibrewal now joining in on the show. And Pankaj, what really is going on with the overall market at the current juncture? What do you believe could be the key reasons for the fall that is stemmed in the markets? Do you think that it's largely on account of the fact that we have seen a ferocious run up on the upside? And where do you see us headed?
Good morning. If you kind of recall, we have been a little cautious on the broader market space for some time now. And our broader concerns were that the valuations had become too rich and greed was clearly visible on the street and money making had become too easy. Over the last decade, mid and small caps have been the best equity class. And we believe that some exercise and some caution needs to be warranted in the short and near term. Uh, we believe that there are 3 or 4 data points if you look at. The first one, if you look at September 12th, the first crack when happened, the breadth of the market has been deteriorating since then. And in the month of September itself, the first indicator was that after March 2023, the median stock return of small cap index was negative, whereas the headline index return was positive. That means that the rally was getting narrower and narrower. And on Monday this week, we saw that the market breadth was one of the worst, with more than 1,200 stocks declining or having a drawdown of more than 3%. The second point, if you look at, is that if you look at the market cap distribution today, the mid and small caps together are about 35% of the overall market cap. Large caps have come down to 65%. But on the other side, when you look at the profit distribution, still the top 100 companies are about 75% of the profit pool, and mid and small caps are about at 25%. So clearly, there's a disconnect between the profit distribution and market cap distribution. The third point, if you look at that, the large cap shares in the overall market cap has come down to one of the lowest levels. Even if you look at large cap market cap ratio versus GDP, it has come down to very reasonable levels. And we believe that some, rotation may happen from mid and small cap in the near term towards large cap, which are in a much better valuation zone. Last but not the least, if you look at, I think from a overall perspective since 2021, large cap market caps have gone up by almost 12 to 13%, whereas the profit pool has gone up by almost 40% on an absolute basis. So we have seen some kind of a de-rating in large caps and equal amount of re-rating or larger re-rating in mid and small caps. So I think in the near term, we believe that there's some caution which needs to be exercised in this space. Everybody is looking at the past 3-5 year returns and believes that small and mid caps are the path to financial nirvana. But we have seen cycles and we know that such situations do not last for long. Cycles have become shorter and sharper. And in order to create wealth in the long term and medium term, we need to navigate short term also with caution.
In your emerging equity fund, help us understand or give us some color at least as to what have been your recent exits. Have you added any names in the recent correction that's played out?
Yeah. So if you look at, from the past cycles, there have been few learnings, and look at 2007-8, look at 2013-14, look at 17-18. One thing which always, is very important is the anchoring to quality. And I think we have not compromised on that. And the basic tenets of our investing remains quality, and making sure that we don't invest in momentum, we don't invest in broken balance sheets, inferior cash flows. And I think that's something which goes on for this cycle as well. Avoid leverage, avoid businesses which are financially levered. And I think that's something which is, again, a very important thing. Keeping those basic things in mind, I think first, I think the filter is that the entrepreneur, the management team should have seen cycles. And most of our investee companies in our portfolio have seen, at least 2 decades of different cycles and have come out stronger and sharper in that. So that's a big comfort that if anything goes wrong globally or locally, management teams are equipped enough. Second, if you look at the overall return profile, I think that's very, very solid at about 17-18% return on equity, return on capital, and cash flow seems to be very strong. And X of financials, the overall aggregate portfolio have a very low leverage as well. So those basic things have been kept in mind. And we believe that pharma is a decent spot. We have been increasing exposure over the last 6-7 months. Financials are in an interesting space today. Valuations have corrected, and we believe that financials also warrant a look post the derating which has happened over the last 12 to 18 months, especially in the larger names on the private sector banks. The third point is the manufacturing side. We believe that the traction continues, the order inflow continues to be strong, and that's another core portion of our portfolio, which will cover different parts, which is capital goods, cement, chemicals, and so on and so forth. Pipes, which is another core part of the infrastructure. Last but not the least, incrementally, we believe that the earnings downgrade cycle in IT could be behind us, and we believe FY25 could be far better than FY24, and we are looking at opportunities in the IT space incrementally as well.
When you say that the cycle in mid and small cap stocks is getting over, should one redeem the units and shift to large cap? A very straightforward and a frank question. It's about asset allocation.
Nikunj bhai, if you look at, I'm not saying cycle is over. We believe that 3-5 year, if economic growth was to continue, this is the best way to play. But medium and long terms are made of short term as well. In the short term, we believe that there's some froth in the space which needs to be cleared out. There could be sharp drawdowns, which we have seen. For example, look at after 2017, there was 2 years of consolidation in 2018-19, where Nifty didn't correct that much, but there was a huge drawdown in 2018 and 19 in the mid and small cap category. When he was sitting in 2017, nothing seemed to have gone wrong, right? But 2018, different sequence of events started panning out, and we saw that finally data doesn't lie. On the hindsight, we come to know the reasons the reasons are there. But today, the data points are similarly pointing out that there has been excess created in the small micro caps, mid caps. Greed is visible on the street. Look at the ISME IPO side, the way the stocks have moved up in the last 12 months or so. So I think that needs some caution. And from a tactical opportunity and asset allocation, what we are advising to our clients is that have some discipline out there and move incremental capital to large caps, which are at a much reasonable valuation zone compared to mid and small caps.
That point of yours, which is a profit pool and market cap, it's a great point that the profit pool is with large cap and market cap right now in terms of the division is with small and mid caps. But what about the absolute earnings growth? Large cap, according to estimates, will grow in the region of about 13 to 16 or 14 to 17% depending on the estimate you have. But for mid and small cap stocks, that number in terms of the rate of growth is far higher. So it is a shift which I think market could prioritize.
Excellent point, Nikunj. Look at two data points. The first one, if you look at profitable companies, apple to apple comparisons, you have seen a derating in large caps and a sharp re-rating in mid and small cap. However, the aggregate number gets completely, misrepresented because there's a lot of loss pool which are sitting in mid cap index and small cap index. And when the loss pool comes down or moves from loss to profit, the aggregate headline profit growth seems to be very large. And that's what is happening in this year, FY24, and probably early part of 25, which is exciting the market. But what we do is we normalize those earnings which are more volatile in nature. Let me give you a small example. If there is a telecom company which is a part of mid-cap index and it reports a loss of say 60,000 crore last year, and if that loss comes to 30,000 crore, suddenly you see that the headline mid-cap earnings growth is looking very strong. But you need to normalize that because you know that probably that's not where you will go and invest in. I'm giving you a small example in that respect. And there are many other companies, even in the small cap index, which had a bad last couple of years. They are moving from either loss to profit or the loss is coming down. So you need to adjust for that. And hence, I think that the differentiation or the difference between large cap growth and then if you adjust the mid and small cap index growth is not that very large.
Where in the mid-cap space, you've mentioned manufacturing as a theme, you mentioned financials as a theme. You think that we are in for high growth and valuations, they are supportive because manufacturing is not cheap. With the exception of private banks, nothing is cheap in this market. Where you are getting a comfort that, okay, I'm not going to be getting it, I'm still getting it cheap and the growth looks decent.
Very limited pockets of that kind of opportunity, Nikunj, to be honest with you. Financials are one space which are quite reasonably valued. And look at one data point. If you bifurcate NSE 500 universe, which is largely what market represents, into two buckets, which is BFSI and non-BFSI. And BFSI are 77 stocks and non-BFSI are 423 stocks. Today, the non-BFSI bucket is trading at an 85% premium to the BFSI bucket. That means that the entire non-BFSI space has been massively re-rated over the last 12 to 18 months or 24 months. Whereas the BFSI, despite of delivering strong earnings growth, has not seen that re-rating. On the contrary, there has been some de-rating in the large private sector banks. So I think that's one space where a lot of comfort could be derived on, and they are delivering on numbers. The second point, if you look at from a overall perspective, if you look at this quarter numbers, till day before yesterday, 90 companies have reported out of the NSE 500 companies. The aggregate profit growth is about 28%. And if you bifurcate between BFSI and non-BFSI, again, out of that 90 companies, 28 companies in BFSI space has delivered 40% earnings growth, and the rest 62 companies on non-BFSI have delivered 18% earnings growth. So it's not been that large. And the third most important point, don't forget that in this quarter, whatever little the numbers have come through, we are not seeing any top line surprises positively. And don't forget that the base quarter last year was the worst margin corporate India has seen in their last 20-year history. So margin expansion is happening, but there's no joy in the top line growth of all the numbers which have been reported. As you move into the third and fourth quarter, raw material, crude have all started inching up, and we need to keep a close watch on how the margin trajectory spans from here. So very little pockets where you think you can go with very high conviction, where valuations are also supportive and growth is also happening. Markets have become smarter in re-rating it very fast. And financials are the one place where we are seeing that opportunity is there, especially in the larger cap banks.
Pankaj, great to have you on the show and get in all that insight from you on how to navigate this weakness within the mid and the small cap space in particular.
Thank you.